What is going on, Z community? It's your boy Tamer Aziz, and today we're going to be talking about the different order types and different order durations of the stock market. Let's get it. Alright, so Z community, some of the market orders that we're going to be talking about are market orders, trailing stop limit orders, some LOCs, LOOs, and when it comes down to the different durations, we're going to be talking about GTC, day durations, GTEMs, and a lot more so that you're actually set up when it comes down to buying and selling your stocks. Alright, so first things first are market orders. When it comes down to market orders, this will basically fill your order or execute your order or make your order go through at the current price that you see the stock going at. For example, if you see that a stock is going at $26.49, you're gonna end up placing that market order, and chances are it's going to fill at $26.49 or higher. Before I go any deeper into the video, I just wanted to let you know that when I say execute order, the order going through or the order being filled, they're all referring to the exact same thing, and that's when you press that confirm button and then the order actually goes into the market and gets that actual stock for you. Anyways, when it comes down to market orders, it's not really a wise choice when it comes down to buying and selling your stocks, because chances are if you are buying, it's going to get filled at a higher price, and if you are selling, it's going to be filled at a lower price. Let's take another example where a stock is selling for $30.10. You end up now placing a market order for this exact same price. Now your expectation is to actually buy it for $30.10, but once the order actually fills in and you look at the details, you're gonna notice that it's either at $30.11, $30.12, $30.13. So chances are you're going to see like differences on the cent level, but if you're buying multiple shares, this does add up, and you might end up having to pay like $5, $10, $100 extra depending on how many shares you're buying. And the same thing applies when you're trying to sell a stock as well. So at that exact same $30.10 point, if that's the point that you want to sell at, when the order goes through, you're going to look at it and it's going to say, oh, filled at $30.09, filled at $30.08, 7 cents, so on and so forth. Now the explanation as to why this happens when it comes down with market orders is too long for me to fit all into this one video, but long story short, it all comes down to the supply and demand within the stock market itself. Now when it comes down to the relationship between this supply and the demand, a lot of people really refer to it as the bid price and the ask price. If you want me to touch up more on this or even make a video, let me know in the comment section down below, and you guys know I'm more than happy to do that for y'all. So let's take an in-depth example of a market order. Alright, so boom, let's just say you see a stock, it's $20 per share, and you're telling yourself, you know what, I'm gonna go in for that. So you end up placing a market order without knowing the differences between the different orders, and you place the order, market order gets filled in. So then you look at the details and it doesn't say $20 per share. It ends up saying $20 and like 3 cents, 4 cents, 5 cents, and you're like, wait, did I do something wrong? Let me try this again. Let me buy another couple of shares. You do the exact same thing, still at the $20 price point, and then you end up pressing buy, and then you look at the details again, $20.07, $20.09, whatever the case may be, and now you're frustrated. So you're going to do Google searches, what's going on. You stumble upon this video. I'm now telling you about market orders, but I'm telling you that there is a better alternative for buying and selling your stocks, and this is the limit order. Limit orders will actually solve the problem of this market order situation. It fixes the problem by you being the one who gets to actually put what price point is the maximum or the minimum that you are willing to buy or sell respectfully. But here's the caveat, because now that you're putting the specific price points for you to either buy or sell, it might take a little longer for the actual orders to go through. For example, you'll notice that when you're doing a market order, bro, it's not even 2 seconds and you already got your stocks. But when you're putting a limit order and you're saying, you know what, I don't want to pay any more than this price, it'll probably take you a few minutes, if not an hour or two, depending on how far away it is from the current price. For example, if a stock is trading at $30.20, it does not make any sense for you to put a limit order for $29.75. That's if you want it to be placed on the same day, because chances are it's too big of a price difference that you're not gonna fill that as soon as possible. The only way that you could actually ever get this done is if you put an order duration of G to C, which is what we're gonna be talking about later on in the video, so be sure that you stay tuned for that. But either way, and to conclude it, a limit order is when you specify the price that you want to buy at. Now let's use one of the last examples to actually explain how limit orders work in more detail. Let's just say the current price of a certain stock that you want is at $20 per share. We're going to be taking two types of situations. The situation where you want to buy them and the situation where you want to sell it now. The first situation where you want to buy the shares at $20 per share, you're going to end up placing a limit order. When you do this, your broker is going to ask you, okay, what is the limit price? Over here, you are going to tell them the maximum that you would ever pay for this stock. And this is all going to depend on you. For example, if you want to just buy at $20 flat, you're going to put 20.00. If you're willing to go a cent or two higher, then you're going to put $20.01, $20.02. You are the one who's in control. Now, the reverse thing happens when you're trying to sell a stock. Say, for example, exact same thing. The stock is at $20 right now, but you've already made profit from it, so now it's time for you to sell. Once you press limit order for the selling, it's going to still ask you what price do you want to sell this at. So instead of you putting in the number that you want to be your maximum per share value, you're going to put the minimum per share value. Let's just say that you put $19.99. This means that you're telling the broker, yo, if it's anything lower than $19.99, don't sell my shares. And again, if you wanted to sell the stock for a flat out $20, you're just going to put $20.00. Once you press confirm your order, the order will not go through until it hits that price that you specified for the broker. This means you get to save both your time and your money by placing limit orders, so big shout out to those limit orders. Next up on the scene, we got LOO orders. LOO is standing for limit on open. Now, to put LOO in the most simple terms, it's the exact same thing as a limit order, but it can only get filled at market open. The exact same way that there are specific stores out there that open at specific times, the stock market also has an open and close time. Now, the stock market opens every single weekday, 9:30 a.m. Unless there's a holiday going on, then it closes down. The exact same thing as other stores that are out there that you go to. And just to say, it's 9 a.m. Eastern Standard Time. So whatever time zone you're living in, just convert that and that's the market open for your end. So because of the nature of this type of order, you basically only have one shot at two different outcomes. So this is also assuming that you are buying the stock, so hear me out. The first type of scenario that you can encounter is that the current price of the stock itself at market open, if this is higher than the limit price that you put in, the order will automatically be cancelled. In the reverse situation, if at the market open, the current price is lower than the limit price you put, then your order is going to get through and you're going to buy those shares for whatever limit price you ended up putting, or even lower if you're lucky. The exact same happens in reverse, so vice versa, if you're trying to sell the stock. So the exact same thing as limit orders. It's just at the market open. That's literally the only difference. So don't let this confuse you too much. But let's look at an example as to when you could actually use a limit on order type of order. Again, let's just say that the stock was trading at $20 the last time you saw it. So let's just say that you looked at the current market price the other day, $20, but you feel like, you know what, $19 is a fair one, but $20 I feel like is just a little bit overrated. But the problem is that you work 9 to 5, so where are you gonna find the time to place the order when you're at work? This is where the limit on order comes clutch. You're basically gonna be using the LOO as an autopilot for you to actually buy these shares. You're gonna obviously place the order, and when you pick LOO, it's going to ask you for your limit price. Your limit price, because you want to buy the stock at $19 per share, you're going to put 19.00. Fast forward to 9:30 a.m. while you're just starting your day off at work. This LOO order is going to look at the current price of what the stock is at right now, and then it's going to make a decision. If it's higher than the limit price that you put, the order is going to get cancelled. If the price is lower than the limit price that you put, it's going to get filled and you just bought stocks while you're at work. Genius, right? Now the next type of order that we have is LOC. Limit on close. And I'm pretty sure you guys can already tell what type of order this is because we literally just talked about its reverse situation. I'll give you 3 seconds to guess it. You guessed right, it's the exact same thing as an LOO, but instead of an order getting filled or getting cancelled at the market open, it happens at the market close. Now for your reference, market close is always at 4 p.m. Eastern Standard Time. So this means instead of you potentially buying or selling the stock at market open being 9:30 a.m., it's going to be happening at like 4 p.m. and the actual order will make a decision for you whether you should actually buy or whether you should actually sell. This also might be something you're interested in as an autopilot feature for when you are at work or just when it's a busy day overall and you don't really have the time to be checking your phone at 4 p.m. ish. So I would give you guys an example for this type of order, but realistically it's the exact same thing as the limit on open order. It's just the only difference is the timing, as I said. Now the next type of order that we're going to be talking about is definitely something that you've heard about before. This infamous order is called the stop order. The stop order is also known as a stop loss order. When it comes down to any type of investments, whether that's day trading, swing trading, long-term investing, stop orders always come clutch. Now with the stop order, there are 2 parts to this order. The first one being a trigger price, and then the second part being the market order. This means that when you are setting up a stop order, it's only going to ask you for one price. You're going to put that price in, okay? Once the stock price hits that specific price that you put in, it's going to do a market order, which means that it's automatically going to get filled. Could be at your price that you wanted, or it could be at a worse price. Let's just look at our example again where the stock is currently at $20, but you want it for $19. Now, I'll be honest with you, when it comes down to a stop order or a stop limit order, which we're going to talk about next, it's not really that helpful if you're trying to buy the stock. It's only helpful when you are trying to sell the stock or if you are trying to cover a short position. Just to put it in simple terms for you, a short is when you are selling high and then buying low for profit. Now I know this does sound a little bit confusing, but bear with me. Let's look at an example of how a stop order or how a stop loss order would actually work. Let's just say that you bought a stock at $15 and it's now at $20. You do feel like there is a little bit of resistance and you feel like it might go down again to like a $19 level. You want to make sure that you protect yourself against any more losses. The maximum that you will ever sell the stock is at $19. So what do you do in this situation? Now, because it's in the $20 range and you're willing to sell it for $19 at the minimum, you are going to open a stop order. A stop order is going to then ask you, okay, what's the price that you are going to sell this at? Like, what's the minimum you are trying to sell it at? At this type of situation, you're going to put $19. Now, because the stock price is at $20 right now, if it ever approaches that point of the $19 level, the stop order is going to get activated. When the stop order gets activated, it's going to automatically do a market order, meaning that it's going to sell your stocks. It's going to sell your stocks maybe at the $19 level, or even at the $19.01 or 2 cents, or even at $18.99, 98 cents, and so on and so forth. The reason as to that part is because it's a market order. Now again, in order for us to fix the problem of having it be a market order and then actually sell your stocks for a lower price, you can solve this issue by using a stop limit order. Now a stop limit order still has 2 parts to it. The first part still being the trigger price, but then the second part is a limit price instead of a market price. And remember, as we said before in the video, limit prices are when you're in control. Looking back at our same example where you are only willing to sell this stock for a minimum of $19, and obviously you want it to go up more, but you've realized that now is like a good time to sell. When you're trying to place your stop limit order, it's still going to ask you for a price to put, but this time it's going to be a limit price. In this limit price over here, you're going to put $19.00. Once you press that order, whenever that $20 mark starts to go down, once it's a little bit above that $19 level, your order is then going to go through. And once you actually look at the details, your stocks just got sold for $19 right on the dot. This is where stop limit orders actually come to save the day. All right, so the next type of order that we're going to be talking about are trailing stop orders. Now, these are probably one of the coolest orders that I have ever come across, them and trailing stop orders, and you're going to see why in a minute, but make sure that you're actually focusing with me on this one. Now, with trailing stop orders, you would usually want to do this if you have already been making a profit or you're on your way to making a profit, and you just want to make sure that you're protecting yourself against any losses. Now, with the other orders that we have just talked about, it's kind of different because you have to kind of tell them a specific price point or a specific percentage that the stock will just automatically sell at. But with trailing stop orders, it's completely different. So let's just say that you own a stock right now that's been skyrocketing, but at the same time, you know that whatever goes up must come down. Even if it's not all the way, but like, you know, to a certain degree, it might go back a little bit. Now, using a trailing stop order, you will be basically limiting the amount that you could actually lose at all times, even if the stock is still going up. So using a trailing stop order, you're basically putting a maximum amount or a maximum percentage of how much you are willing to lose if the stock does decide to go downhill. Now, you could actually program this trailing stop order by putting a specific percentage or a specific price point from wherever the stock is going to be at. So let's just say, for example, you could put 5% or $5. If it ever goes down that specific amount, it's just going to automatically sell for you. Let's look at a little bit of an example so you see what I'm trying to say right over here with the trailing stop loss order. So let's just say that, for example, you put yourself a cap of either 5% or $5. If the price ever goes down those certain amounts, then you're automatically going to get your shares of stock sold. Now, let's actually look at an example so you see how this trailing stop order actually goes about. So let's just say you bought a stock $200. It's skyrocketed and now it's at $500. Congratulations, dab me up. Yeah. Now you've made a good deal of profit so far, but at the same time, you don't want to be too greedy. So you decide that you're going to set up a trailing stop order. And this trailing stop order is only going to ask you for one thing. This one thing is going to be called the trailing amount. Now, this trailing amount could either be, as I said, a dollar amount or a specific percentage. For the example's sake, let's just say that you put 1% or $5, which at $500, it's basically the exact same thing. For simplicity's sake, let's just say that you put the trailing amount at $5. So now, because we know that the actual stock price right now is $500, if it ever goes down to $495.01, you have absolutely nothing to worry about. But as soon as that price hits $495 on the dot, then you're in a sticky situation. You're in a sticky situation because then the stop order is going to be triggered and then it's going to automatically sell at the price that it's at right now, which is $495 more or less. Now, you probably have two questions, and the first question is, okay, well, what happens if it actually goes higher than $500 or it just never hits that $495 price point? Now, you still have nothing to worry about because as the price keeps going up, your actual dollar amount will also go up with it. For example, if let's just say now we're at $510, this doesn't mean that whenever it goes down to $495, it's going to sell again. No, it's still going to be $5 less than whatever the current price is, which is why I'm saying that this is probably one of the dopest orders that I have ever come across. So again, if it's at $510 now, and then it ends up dropping to $505, then that's when the stop order is going to be triggered, and then you're going to be forced to sell your shares basically. The exact same thing applies if you put a percentage. Rather than it being 1% of $500, now it's actually 1% of $510. And this is exactly why it's called a trailing stop order, because it follows the actual current price and it kind of automates the process for you. Now, the second question that you probably have is, what if I just want to sell at a specific price point and I don't want it to go below that price whatsoever? Well, the answer to this question is actually looking into the next order, which is also known as a trailing stop limit order. Now, the trailing stop limit order is the exact same thing as a trailing stop order. The only difference is rather than only asking you for one thing, being the trailing amount, it's also going to ask you for the limit price. The trailing amount again is going to be a percentage or a specific dollar amount that you can choose, and then the limit price is going to be the absolute minimum that you are willing to sell the actual shares for. Let's use our example again, where now the price is at $500. Now, assuming that you still have the trailing amount at $5, let's put that to the side. And now you're going to actually decide on your limit price. Let's just say your limit price is going to be $490 and that's it. Now fast forward a couple of days, a couple of hours, or even a couple of weeks, and now you realize that your stock price has actually went up to $550. Pretty awesome, right? First things first, if you don't want to be greedy anymore and you just want to sell the shares at $550, you could just cancel the trailing stop limit order and then sell the shares from there. But if you just want to automate the entire process, what this trailing stop limit order is going to do for you is actually still follow that percentage or that dollar amount that you put. Saying that you put the $5 amount, it's at $550. What's $550 minus $5? Yup, $545. Once its current price hits this $545, then it's going to trigger the stop order, which means that now it's in selling mode. It's waiting for your limit price to hit of $490. If the stock price tries to tank down and then it hits 490, then your shares have been sold. What this means is you're still going to be making a huge profit of more than $500, and it's a win-win situation because at the end of the day, you're selling at a much higher price point than what you anticipated or what your maximum loss tolerance would have been. So what this means for you is that you're still going to be making a fair amount of profits while you're still keeping yourself safe by saying, yo, you know what, 490 is the minimum that I will sell this for. But just in case something good happens, then sell it at whenever it hits like below that $5 target or that percentage that you put. So this puts you in a super safe situation, and this is why I love trailing stop limit orders. It's a win-win situation. Nobody ends up crying at the end of the day. It's happy days. So when it comes down to all of these different types of orders, there's actually a way where you can combine them all together to make the most efficient type of order for when you're buying or selling your stocks. The way that you can combine them all is by doing something called a bracket order. Bracket orders allow you to do one of the best customizations out there because it takes 4 of the market orders that we just talked about and combines them all into one. Now, the way that these bracket orders work is that they give you 3 different steps. The first step is going to be your buying order. The second step is going to be your profit limit, which is going to be when are you going to try to profit off of this stock. And then the third part is going to be your loss limit, which is what is the absolute maximum that you're willing to lose on this stock. Now for the first bracket, because it's going to be a buying order, you do have the freedom of picking whatever type of market order that you want, whether that's, again, a market order, limit order, stop limit. Like, it's all up to you at this point. Now for the second bracket, it's probably going to ask you to do a stop limit, which is what is the maximum or what is the minimum price that you want to actually profit off of this trade. And the third bracket is made up of either a stop loss or a trailing stop loss, which will ask you for basically 2 things. The first thing, which is going to be the stop price, which is when the actual trigger goes off. And then if you did a trailing stop limit order, then it's going to ask you for the trailing amount and the limit. Now, we've already talked about how each of these different types of orders work individually. So let's look at an example of how the bracket order works overall. What's going on, Z community? I'm sorry to interrupt, but I wanted to let you guys know that we just released our Z line. Now, the Z line is going to be a phone number where you can text me at any given point of time. Any questions that you guys might have, or even follow-ups to certain videos, give me a shout and I'm more than happy to help out. On top of this, I'm going to be giving you guys some motivational texts from time to time, and even some specific things to look out for when it comes down to investing within the stock market, or even just things when it comes down to credit. So don't miss out on this opportunity to get in-demand help by texting the number that you see on this screen right now. I've also put this number in my description if you want to check it out, and I also promise that I'm not going to be R-bombing. Alright, thanks Z community. Now enjoy the rest of the video. Now let's look at the first example of you buying something using a bracket order. So let's just say that you're going to day trade this stock right now. And with day trading, you gotta have yourself an entry point, an exit point, and a profit point, which is where everything in this bracket order just makes it so simple. So with this one stock, you've decided that you're going to enter when it's at $20 per share. You want to get a profit when it's selling at $20.20, and the maximum loss that you can tolerate is when it's 5 cents below this $20, meaning the minimum you'll sell it for at a loss is $19.95. Now with the bracket order, as we've talked about, it's going to ask you for three things. The first thing is going to be asking you about where you're going to buy this stock. When you're buying this stock for this specific trade, you've already made up your mind that you're going to buy at exactly $20. So you're going to make sure that under this first thing that it asks you for, it's a limit order, and you're going to put $20.00. This will make sure that you will buy the stocks at $20 or even less sometimes. Now the second thing it's going to be asking you for is going to be a little section that says profit limit or profit gainer. Different brokers call it different things, but it's going to be the second thing it asks you for. Now you've already decided that you want to take profits when the stock is trading at $20.20. So again, because you want to make sure that you sell it at $20.20 on the dot, you want to make sure that it's a limit order again at $20.20. This means that the order will only sell if it hits that price point or higher if you are lucky once again. And then the last thing that it'll ask you for, which will, again, it'll be called different things, but it's basically the exact same elements. Now with this third thing that they ask you for, they really give you two options that you can pick from. Either a regular stop limit order or a trailing stop limit order. Both options will help you put a cap at how much you can lose on this trade. But for example purposes, I'm going to be breaking down both of them. So the first thing that we're going to be looking at is if you did this under a stop limit order. Now, as we talked about, you're going to have to put your stop price first. This will basically be the trigger point as to when the order is going to be in selling mode and when it's going to be ready to sell your stock, just in case it hits that $19.95 price level. Now, you want to make sure that with the stop limit order, you don't put it exactly at $19.95. There is a risk that you might end up selling the shares at a price point that's lower, which means that you're going to lose more money, and that's not what you want when you're trying to day trade. So for the stop price, you want to put it somewhere like, let's just say 1997, 1998, 1996, just anything over your maximum loss that you can tolerate. Now the next thing they're going to ask you for is the actual limit price itself. Now with this price, you want to make sure that you put the absolute maximum that you are willing to lose on this trade. And in this case, you want to put it at $19.95 because it is 5 cents lower than $20 on the dot. So putting this all together, you're basically going to be entering the trade at $20 exactly. You are aiming to get a profit and sell at $20.20, and the absolute maximum you're willing to lose is if the stock goes down to $19.95. Remember, if it hits that 1997, 1996, whatever price you ended up putting in, it's going to be in selling mode to be ready to sell for a loss. And then once it hits the 1995, boom, it's not going to be selling at anything lower than that price. But now in this situation, what if you actually picked a trailing stop limit order? Now this basically follows the exact same thing if you were doing a stop limit order, but the only difference is that now it's going to also ask you for the trailing amount. Now for the trailing amount, you've already established that you are willing to lose 5 cents. That's the maximum. So 5 cents is something that you would want to put in this trailing amount. Then obviously your limit price for the stop portion of this order, you're obviously going to have to put your maximum that you're willing to lose, which is in this case is going to be $19.95. But now let's put this together, because looking at the trailing stop limit order overall is completely different than looking at the stop limit order as a whole. So take this in, okay? You've established you're gonna get in $20, okay? Boom, that's it. And we all know that you want to get $20.20. That's when you're exiting, and that's when you're taking your profits. Now let this sink in for a second. With the trailing stop limit order, let's just say here we are at $20 per share. Let's just say that it just stays there, okay? When it's staying there, you are still going to have 5 cents that you can lose. But if it ends up going to $20.01, then this is actually going to move up. Your maximum loss is going to move up. So rather than you actually needing to sell at $19.95, now it's going to be $19.96. Same thing if it goes up to $20.02. this is also going to rise up, being you selling at the maximum of $19.97. If the price goes up to $20.03, you're going to be selling at a maximum of $19.98. So on and so forth. And that's the beauty of it. With the trailing stop limit order, you're actually decreasing the amount that you could ever lose if the stock just keeps going back up and down. Because of that trailing amount that you ended up putting, anything that's lower than 5 cents of whatever the current price is just going to automatically sell for you, and you actually might even be in the green sometimes. Now let's look into the other example where you are trying to now sell a stock, but you're going to be using a bracket order. This is only going to be useful if you are actually thinking of shorting stocks or day trading stocks while you are shorting them. Just a brief overview on what shorting stocks is. It's the complete opposite of what you know to be investing in the stock market. Instead of buying low and selling high, shorting is when you sell high and then buy low for profit. I know it sounds really messed up, but a lot of people make money that way. So let's actually move on with the example. Let's just say you're looking at a stock right now and you're looking at the price and you're like, nah, I definitely think this is gonna go down. You've decided that now you're going to short this stock. You're going to sell when it's high and then buy when it's low. So using different numbers so I don't confuse you with the other example that we just did, let's just say that you're looking at the price and it's at $10 per share. Because you're shorting it, you want to take your profits at $9.80, and the maximum you are willing to lose is if the stock hits $10.05. Now again, similar to buying with the bracket orders, it's going to give you 3 different options. The first one being where are you going to buy, or in this case sell at, where are you trying to get profits, and where is your maximum loss tolerance. So for the first part where it's asking you, okay, where do you want to buy or sell in this type of situation, you're going to put that $10 price point because that's where you want to enter. Again, make sure that it is a limit order so that you guarantee that it gets filled at this price or even better. Now the second bracket, which is going to be the actual profit order. Now, as we've just discussed, you have decided that you want to take profits when it's at $9.80. So again, you're going to make sure that you put a limit order at $9.80. This means that the maximum profit you'll be making on this trade is $9.80, and that's it. Now the third bracket, they're going to give you 2 options. Either the stop limit order or the trailing stop limit order. Now you're going to want to put your stop price first. And again, you're going to want to make sure in this type of situation that you put the stop price a little bit higher than your actual exit point, because if you don't, then it's going to hit that exit point and then you're going to end up losing more. Now let's just say that you decide to do a stop limit order. Let's see how this is going to look. First thing it's going to ask you for is the stop price. Now again, the stop price is right before your maximum loss tolerance, and because you have decided that your maximum stop tolerance is going to be $10.05, you're going to want to put your stop price at around, say, $10.03, $10.02, $10.04. It's really up to you. You're the one who's creating that space in between. Then it's going to ask you for that limit price. Now the limit price is the absolute maximum you're willing to lose. And because you've decided that that is going to be $10.05, that's what you're going to put for the limit price. So putting this all together, this is going to be a shorting order, which is the opposite of traditional investing, meaning that you are going to sell when the stock is at $10. You're going to want to try to profit when it's at $9.80, and you are going to buy back the shares at a loss if it hits $10.05. Now, how about a trailing stop limit order for when you are shorting stocks? It's the exact same thing as a stop limit order. Again, the only difference is when you're actually being asked for the trailing amount. The trailing amount, as we have just talked about, is going to be the maximum you're willing to lose in terms of how much away it's going to be from the price you entered. In this case, you've told yourself, I'm only willing to lose 5 cents on this trade, so you're going to put a trailing amount of 5 cents. The limit price, again, is going to be the maximum that you are willing to take a loss, which in this case is going to be $10.05. Now again, putting this all together for the trailing stop limit order, you're going to be selling the stock when it's at $10. You want to make a profit when it's at $9.80, and you're going to be buying back the shares when it's at $10.05. Now let's just say that over here, here's the $10 level. it goes a little bit down, which means you're making profit now. When this goes down, so does the trailing amount. And let's just say that right now it's at $9.90. If it ever hits $9.95, then you're actually going to be still making a profit because it's a trailing stop limit order. You're not going to be taking a loss at that $10.05 point anymore. It's going to be buying back the shares for you at $9.95, meaning that you profited 5 cents off the trade and you didn't even make a loss, which is where, again, the beauty of this trailing stop limit order comes into play. Alright, so with all of these different types of orders, you can actually dictate how long they will actually stay in effect. This is so that at the end of the day, you don't end up having to come every single day just to place the same bracket order. The first type of order duration is the day duration. And basically with this type of duration, anything that does not get filled or does not go through before 4 p.m., which is closing time of the market, it's automatically going to get canceled. The next type of order duration is GTC, which is also known as good till canceled. This is the exact opposite of what a day order is, because with the GTC duration, the order will never expire. You're gonna have to be the one who actually modifies it and cancels it manually, because it literally will not expire at all. So for example, if you wanted to buy a stock at a limit price of $10 per share and you put it as a GTC duration, you could literally be waiting 56 years for you to get that stock. Yeah, it's pretty cool, but at the same time, like, if you forget, you're basically like, whoa, you know what I mean? The next type of order duration is GTD, good till date. Now with this type of order duration, it will last you for 90 calendar days, not business days, actual calendar days. This is taking into account weekdays, weekends, holidays, all of that good stuff. It's a 90-day total. After these 90 days are done, your order gets canceled. So with that same stock that you want to buy for $10 a share, if you ended up doing a GTD order on January the 1st, you're gonna have to hope that it gets filled before that 90 days is going to be over, which would be March the 31st or the 30th per se. Yeah, you know what I mean. The next order duration is GTEM, good till extended market. Now this type of order duration actually works the exact same way as a day order, except the only difference is that instead of it being canceled at market close, it actually goes until after market hours. Yeah, now believe it or not, the after market hours, there's literally a time window from after the market closes where people with special benefits, or like, I don't know, certain people out there, they can still buy and sell stocks within after hours. After hours is what they know as the aftermarket hours or post-market trading hours. Think of this as more as the overtime shift. Now basically with GTEM order duration types, what this means for you is that you can still get your order filled even after the market closes. So for example, that same $10 stock that you really want to buy, if it didn't get filled by market close, then you don't have to worry because you still have a chance to get it filled within the aftermarket session. But do keep in mind, the aftermarket hours also has a closing point. So you gotta be sure that it gets filled in that, or else it's going to get canceled as well. Now aftermarket hours vary from broker to broker, but for Questrade, the aftermarket hours for Canadian stocks are between 4 p.m. and 5 p.m. and that for American stocks is between 4 p.m. and 5:30 p.m. The next type of order duration out there are called IOCs, which are immediate or cancel. Now, the reason why you would want to do an IOC duration order is if you want to fill this order as soon as possible. It's kind of similar to a market order, but this is when you're dealing with a bunch of different shares. Now, when I'm talking about a bunch of shares, I'm not talking about 10 shares, 20 shares, 30 shares. I'm talking about 1,000 shares, 100,000s of shares. That type of thing, that's what we're dealing with over here. And when you're dealing with that many shares within the stock market, you're gonna have to worry a little bit more about supply and demand issues, which is why people use this type of order and another type of order we're gonna be talking about, which is the FOK. Now with the IOC orders, you're gonna get two types of outcomes. The first outcome is that everything is going to get filled right away. Your 100,000 shares are gonna go through, that's it. Or only a portion of the shares that you wanted to get will go through, but the rest of it will get canceled. For example, if you wanted to buy, let's say, for simplicity's sake, obviously with this type of order you're gonna have a lot more shares to deal with, but I'm only simplifying the numbers here. Let's just say you wanted to buy 10 shares of stock, but you're kind of scared, is it gonna get filled, is it not gonna get filled? So you end up placing an order for 10 shares in an IOC duration. What this means, two things. The first thing is you can get all 10 shares at once, that's it. Or you can get 3 shares, but then the order for the 7 shares gets canceled. You can get 5 shares, but then the other 5 shares get canceled. 6 shares, 4 shares get canceled. So on and so forth. If this is an issue that you don't want to deal with and you want to make sure that all of your shares get filled at once and get filled at one price, then you're gonna have to actually look into the FOK order, which is also known as fill or kill. Shout out to my guy Phil if you're watching this. Now I like to call this the all or none strategy because it's literally that. It's either you're getting all of your shares filled at the exact same time at that very moment, or it's getting canceled and you're not getting them filled at all. Now you would actually want to use this type of duration if you don't really care about anything else but the amount of shares of stock that you're trying to get. For example, if you're just trying to get 100,000 shares of stock and you don't really care, you just want those 100,000 shares, you're going to be doing an FOK duration order. And again, if you do see that you want shares for $25 per share and you want 100,000 shares, you're going to place this order. Only 2 outcomes are going to come out of this one, which is either you're going to get all of your 100,000 shares or you're going to get none. Now for Questrade, this option is only available with US stocks. For other brokers, it might be different, but I suggest you look into it. That's all I know for Questrade. I hope you learned about all the types of orders and durations. If you do have any questions, let me know in the comment section down below. But question of the week is going to be, what type of order types and what type of order durations will you be using for your trading strategies? Also, let me know in the comment section down below, and I'm looking forward to hearing from you guys. This is me, Tamer Aziz, signing out. Peace out.